Okay, welcome to another video in macroeconomics. Today, we're going to discuss the role that commercial banks play in money creation in a modern economy. Now, for a lot of people, it may not come as a surprise, as we have already discussed, that money creation falls within the responsibility of the central bank of the economy. But what is perhaps a little bit more surprising is that in a modern economy, under what we have been discussing, which is called a fractional reserve banking system, the commercial banks also create money through the credit they give in what is called the monetary multiplier. So in today's lecture, we want to discuss that in detail. So how does the fractional reserve banking system work? In a nutshell, we've already been discussing it. Just to review, basically, the bank receives loans from the public. The public lend money to the bank. The bank takes that. Those loans are short-term goals, meaning loans, meaning the people, when you lend your money to the bank, also known as when you have a bank account and deposit money there, believe it or not, and whether you know it or not, you are lending money to the bank. What kind of loan is that? It's like a mortgage that you pay in 30 years? No, it's a short-term loan, meaning you can show up to a bank anytime you want and say to a bank, pay me back. So that's why that's called high liquidity or short-term loan. Now, what does the bank do? The bank turns around with that money and goes and gives out loans to a firm who wants to make a factory that's going to take 5 years to construct. And so the bank is going to borrow short-term, turn around and give long-term loans. Now, what is the bank business in doing that? It's because short-term loans are going to have low interest rate. Long-term loans, because the structure of payment is a lot more spread over time, you're going to need to compensate the bank more. You're going to have higher interest rate, and the bank earns an interest differential. Borrow short-term, lend long-term. That's another way. We discussed that when we talk about the ways in which the financial system creates liquidity. It's also how the banks make money, other than charging you $1 million fees for no reason. Anyway, so now this creates a little bit of a problem for the bank, because if everybody who lend money to the bank shows up at the same time and wants their money back, the bank doesn't have enough money, because the bank grabbed that money and gave it to the investment company who wanted to build a factory. So what does the bank do? The bank just keeps a little bit, a fraction. That's why it's called fractional reserve. A fraction of its debts, a fraction of the deposits that the bank has, which from the point of view of the bank is a liability. So a fraction of that will be held as reserves. Where? In the central bank, as we already discussed. And so that's why it's called fractional reserve. Okay. So under this system, what we will see what happens is the total amount of money gets amplified by this system. Okay. Why? Because when the bank turns around and gives another loan in the form of a credit, that money is going to be deposited in another bank account. And as you remember from a discussion of money, money is defined as any asset that can be transformed into goods and services. So when I turn around and deposit that money into somebody's checking account, that checking account you can use to buy tomatoes. So that's also money. Okay. Let's look at how this process works. To understand that, let's look a little bit at the balance sheet of a commercial bank. We already looked at it, just as a reminder. From the point of view of a commercial bank, the liability is the deposits. Your bank account is a liability. It's the money the bank owes to its customers. And then from a point of view of its assets, the bank has the loans that it has given. The loan is an asset that it's a long-term asset. It's going to keep paying you for 20 years until the company paid all the money back. And then the bank has reserve. That's the cash that the bank uses to pay people who want to collect their liabilities. To people who want to cash out their deposits, the bank has the reserves to pay for that. So the assets of the bank is the loan portfolio and the reserve. The liability is the deposits. The reserve ratio essentially is the fraction of the debts that the bank can pay. So it's the ratio between the deposits and the reserve. So in this example, the bank owes $1 million to its customers, has 100,000 in reserve, so the reserve ratio is 10%, meaning if 10% of the depositors want their money back, the bank has enough money. If more than 10% show up and want their money back, the bank goes bankrupt. Okay, when that happens, it's what we call a bank run. People trying to get all their money out at the same time. Notice the bank may have a very solid asset, so that's not really it's not a question of solvency for the bank, because the bank may have or may not have, maybe it does have a very solvent loan portfolio with very good quality loans, but the fact that those loans are long-term means the bank doesn't have, has kind of like a liquidity problem, doesn't have enough money today to give to its customers, and so it will go bankrupt. That obviously can create a lot of problems for an economy. We'll discuss that in another video. So today what we want to understand is how does this process of secondary money creation or creation of money by commercial banks through credit work. So we're going to do a simple example. Suppose that the Fed deposits $1,000 into First National Bank. How will that affect the First National Bank? So the new money created in this example will be $1,000. Okay. Now, how does this get amplified by the commercial bank? So the First National Bank now has $1,000 extra deposits and $1,000 extra reserve. Let's suppose that we have a reserve ratio to deposit ratio of 10%. So what does that mean? It means First National Bank is going to keep 10% of this $1,000 in deposit as reserve, so $100 as reserve, and it's going to go out around and give a loan for $900. Okay, so now those $900 are just sitting there, so the National Bank is going to give a loan to somebody else. Now, let's suppose that it gives a loan to Steve, or Steve takes that money and puts it in a bank. It don't matter. The point is that $900 gets deposited back into a financial system. Let's say they get deposited into Second National Bank. So now Second National Bank will have $900 extra deposits and $900 extra reserves. Now already notice what's going on here. Already in this transaction, money has been created because, remember, the deposits is an asset that can be transformed into a tomato. So you can go to a store and with your checking card, what does it mean that you have a debit card or a checking card, or back in the day a check? It means you're paying the store with this asset that says the bank owes me money and you can collect it anytime you want. That's essentially what you're doing. You're paying with the asset cash, bank deposit. So how many bank deposits are in this economy already? There's the $1,000 in reserve, which is $100 reserve in First National Bank, and the $900 in reserve in the Second National Bank. But if we ignore that, because that's a reserve, will be out of the system, in terms of deposits, we already have 1,000 in Bank 1 and 900 in Bank 2. We have 1,900. But so already $900 worth of money has been created here. So this process obviously doesn't end here, because now the second bank has $900 of reserve, but only needs to keep 10% of that. So it's only going to keep $90, and it's going to give another loan of $810. And somebody's going to deposit that in another bank, and so deposits will go up in the Third National Bank by 10% and so on. So if we keep repeating this process, we see each additional time deposits will grow up by 90% of the previous time. And 90% of 90% is 0.9 squared, 90% of 90% of 90% is 0.9 cubed, and so on. So if we keep adding this, what we end up is this infinite sum where every time we're adding, this process that never ends, but every time we're adding a smaller number. Okay, we start first, we add the $1,000, then we add 900, then 810, then 90% of 810, and so on. And so using some simple mathematical computations that you don't have to really worry about, we know that this infinite sum, even though we're adding infinitely many terms, because the terms keep getting smaller and smaller and smaller, it actually, the more terms you add, the closer you're going to get to a number, which is 1 over 1 minus the number you keep squaring. So in this case, 0.9. And so 1 over 1 minus 0.9 is basically 1 over 0.1. Notice that 0.1 is what we picked as our reserve requirement, reserve to deposit ratio. And so that means that for every dollar additional in the system that is deposited, the banks will create $10 worth of bank accounts, deposits in the bank account. And that will be what we call a money multiplier of 10. Okay, the initial dollar gets multiplied by 10 and the total amount of money in the economy increases by 10, even though the monetary base increased by 1. So the monetary base is the extra bill increased, in our example, by 1,000, but because of this multiplier effect of the money being redeposited, the total amount of money in the economy, the money supply, will grow by 10,000, not by 1,000, so a factor of 10. That factor is what we call the money multiplier. And as we can see from our simple example, our money multiplier is simply 1 over the reserve ratio. So if the reserve ratio was 0.2 instead, and we added $500 worth of money into the system, the monetary base will go up by $500, then the total amount of bank deposits will go up by $2,500. And so in this case, we'll have a smaller multiplier. So you can see, obviously, the lower the reserve requirement, the more of the initial deposit gets given out as loans, and so the multiplier will be bigger. The greater the reserve requirement, the smaller will be the multiplier. Okay. So basically, you can see what is the total effect by looking at what happened the monetary base, which is the currency, plus what happened with the bank deposits. Okay. So let me just finish here then with a simple example. Suppose there is $5 million of bank reserve in Econoland and the public does not hold any currency. If the bank desired reserve to deposit ratio is 0.25, then what is the money supply? Well, the money supply will be 1 over 0.25 times the 5 million, so it will be 4 times that. So here the money multiplier will be 4 times. In other words, the commercial banks expand or multiply the amount of money that the central bank puts in the system by a factor of 4. Okay. All right, let's finish here. Thanks for watching.